Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing CloudMD stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. CloudMD offers a comprehensive digitally connected platform for corporations and insurers to better manage employees and customers. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 2013. It went public last year and currently trades on the Pink Sheets, TSX Venture, and the Deutsche Börse. It services 15,000 psychiatrists and therapists, 22,000 physicians, 34,000 medical specialists, 500 clinics across North America. Let's get started with the model. This is a small cap company. 415 million market cap. They're trading at $2.10 a share, and they have 198 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow each year as they're growing their business. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also negative every year since their revenue is low and they haven't hit break even yet. Revenue is the sales for the company, and that's growing nicely. It doubled from 2019 to 2020. It's up to 15 million. This is the company's income statement. The top line is the revenue, the sales, and all the numbers in this video are in Canadian dollars. So you can see their sales have grown a lot, from 1 million up to 15 million. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. That was 9.3 million in 2020. Below that is the gross profit, which was 5.8 million. Then below that is operating expenses. Depreciation and marketing are examples of that. And below that is operating income. Since their revenue is still pretty low, they have negative operating income every year. Below that is the interest they pay in their debt. They paid the most interest in 2020 at 1.3 million. Then you have other income and expenses. This is usually impairments or write-offs. And then the bottom line of the income statement is their net income, which is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses on its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Then you have capital expenditures, which are pretty small for this company. Operating cash flow minus capex gives you your free cash flow, and their free cash flow is negative every year, so they're using debt and equity to run their business. In the past 4 years, they only issued $800,000 of debt. They have been paying down debt. They paid down 2.5 million in 2020 and $500,000 in 2019. When a company has low revenue, most of their funding should be from equity and not debt. They issued 3.5 million of equity in 2018, 4.5 million in 2019, and 76 million in 2020. Every time a company issues capital stock, it increases the shares outstanding, making your shares less valuable. Also, 2 months ago, they issued $55 million of stock. Most of the capital they are raising is used to acquire other companies. Let's look at the capital structure. 107 million of equity, 7 million of debt. They're 94% equity, 6% debt. Their net debt is negative 52 million, and their WACC is 9.8%. And that's the discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7. That's 1.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $863 million. We divide that by 198 million shares. And we get a calculated stock price of $4.36. They're trading at $2.10, so they're trading at a 52% discount. It's a strong buy according to the model. Simply Wall Street is even higher than me. They're at $6.50 a share. This is the previous and forecasted telehealth market across the entire world. And by 2025, it should hit $55 billion. About half of that is in North America. So I projected by 2027, This number should be about 100 billion, and North America should be about 50 billion. I felt it was reasonable for this company to have $500 million of revenue by 2027, which is 1% of the 50 billion. I also projected they would convert 20% of that revenue into free cash flow. That's how I came up with the $100 million in 2027. And then I just backfilled the prior years based on that 100 million. This is the stock price since it IPO'd. It looks like the stock was trading in the low threes at some points. It's come down a little bit. It's at 210, which is higher than its IPO price, but a bit lower than its all-time high. This company has been trying to grow its brand by buying other businesses. In 2020, they bought 5 businesses, and already in 2021, they bought 4 businesses. This is one strategy to grow your business. Another strategy is to grow organically, or a combination of both. Their beta is 1.47, so the stock is a little volatile. It moves about 1.5 times the market. The stock has gone up 184% in the past 52 weeks, while the S&P 500 went up 47%. The 52-week low was 54 cents, the high was 343. And the stock is trading above its 50-day, but below its 200-day moving average. On average, 1.6 million shares are traded each day in the past 3 months. Of the 198 million shares outstanding, 161 million are on float. Less than 1% are held by institutions, and less than 1% of the shares are shorted. In the past year, this stock has gone up 150%, while its industry went up 51% and the market went up 40%. This says the stock has gone up 740% in the past 3 years, but I'm not sure this is the correct number. Analysts are forecasting their earnings to grow 74%, while its industry grows 73% and the market grows 21%. Analysts are forecasting their revenue to grow 38%, its industry 20%, and the market 7.5%. In the past 5 years, their annual earnings decreased 51%, while its industry increased 14% and the market increased 12%. In the past year, their earnings decreased 75%, its industry increased 107%, and the market increased 7.6%. If you invested $10,000 into this company when it IPO'd, you'd be at $9,200 today. That's an 8% loss. The biggest shareholder is the founder at 1.3%, then Stone Castle, then Mark Kohler, Aberis Investment, and then another executive at the firm. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Their price of sales is 27.7, so investors are paying $28 for $1 revenue. Price to book is 3.9. They have negative EBIT, so they have negative return on invested capital, also negative interest coverage ratio, negative ROE, and their current ratio is 8.3. Their current assets are $59.7 million of cash, but this does not include the recent capital raise they did a couple months ago. The company is well capitalized. They only had negative $8 million of free cash flow and $56 million of working capital, plus the additional capital raise that was done recently. So they have plenty of cash to get through the next 12 months or acquire some more businesses. The best way to look at ratios to compare them to companies in the same industry. I've done 4 other companies in the same industry as CloudMD, and if CloudMD has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at the PE. They're worse than average in price to sales. They're a lot better in price to book. They have a really high current ratio. Most companies in this industry have negative earnings, so most of them have negative ROE. CloudMD has the lowest amount of debt, and they're a really small company. So to summarize, I have them trading at a 52% discount, but investing in a penny stock can be really risky. But I feel a little more comfortable with this stock because they are bringing in revenue and a lot of people are using their platform. If that continues, the sky is a limit for this stock. I rank their free cash flows 1 out of 10, their revenue 4 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.